We're here to talk about Silicon Valley real estate market conditions as of November 9th, 2024. Here are the chapters that are in this YouTube. You can go to the chapter that's most interesting to you. I'm Richard Calhoun, real estate broker with Creekside Realty. We're working with buyers or sellers here in Silicon Valley. Let's get into the data. Here's sort of a summary slide. We're starting off with inventory, the current values. There's 2,217 listings currently available. That's 87.5% of the normal level of inventory. So we have a shortage. What I have going on all these graphs here is the gray line here is the normal, defined as the 10-year median. The blue is a cool marketplace. In the case of inventory, the most inventory you'd expect, and that's the 90 percentile of the previous 10 years. And the red is the hottest, the least amount of inventory you'd expect based on the last 10 years. So you can see you're below the gray line towards the hot marketplace. A shortage of inventory is a hotter marketplace. And then the value on the left-hand side is where we were a quarter ago. So it allows you to see recent trends of the 5 key indicators. The next key indicator is our offers are accepted. We're at 2,041. That's 81% of the offers you'd expect. You're missing more offers than you're missing inventory. So you're not in an inventory restricted marketplace, even though it may feel like that. And to be in an inventory restricted marketplace, you'd have to at least be at 100%. In this case, you're below 100% when you do the ratio, and that would indicate you have more inventory than necessary for the level of offers. Looking on days of unsold inventory, days of unsold inventory is the turnover rate, the inventory, sellers, buyer demand ratio. And here you're basically in balance at 97% of the days of unsold inventory you'd expect. You're at 47.5 days. You can see you're just below the typical marketplace, and you're not a little bit on the hot side, which is the shortage. You got a shortage of 3.2%, which is nothing. Moving on to an easier to understand metric, because inventory and offers are easy to understand. An easier to understand metric is days on marketplace. How long is it taking 3/4 of the sellers to sell their property? And right now that's taking 30 days. And that's basically at 101% of normal. So that's basically as close to normal as you can get. And you can see the pattern has been basically right on the gray line. Earlier in the quarter, earlier in the past 13 weeks, it was even slower, and then we have recovered. It is noteworthy that even though you're normal now, when you were slower than normal back here at the beginning of the moving quarter, you were at 27 days and you're at 30 days now. So you've picked up 3 days on marketing time, so you've slowed down, but that's still a faster market compared to normal because the slowdown is faster than it has been this year. Now we're looking at the average price reductions, and this you got to be careful on. Since the vast majority of the sellers take no price reductions at all, the average is a very tight metric. But you can see we were started off taking a little bit more price reductions than normal, 20% more than normal at 1.03%, so just over 1% of a price reduction. And now you're taking 1.15% price reduction, which is essentially at normal. It's 101% of normal. So you've improved by basically 20 percentage points. Overbidding, here I didn't do it as a percentage, I just did it as raw count. Normally you'd have 4.6% overbidding at this time of the year, and you're at 6.4. To me, the big takeaway is basically starting 12 weeks ago, you started to get more and more overbidding, and it's progressively getting larger and larger separation. That to me indicates that the buyers are feeling the need to overbid to buy a property now versus wait till next year. To me, that speaks volumes for next year being a competitive year. At least the bulk of the buyers that are actively buying now feel that way, and they're willing to overbid now more than normal to get out of the marketplace and to own real estate. Here are the 3 key indicators. The purple line is the inventory. You can see you're about 88% of the normal level of inventory, followed by the number of offers in the orange. The number of offers is 82% of normal, and the speed of the marketplace measured by days of unsold inventory in the gray is about 97% of normal. A tentative observer might say, hey, if the inventory is greater than offers, why isn't this over 100%? And it's simply that the 3 metric has everything's based on percent of median for the past 10 years. And the median for inventory, median for offers, and medians of days of unsold inventory occurs in different years. So there is no direct one-to-one ratio as one might initially expect, but you're close to the same ratio and you're close to 100%, which is what you'd expect. And as it pulls away, you'd expect the number to go up, but there is not necessarily a direct one-to-one like a math formula. Now you're looking at the inventory. We're going to take one component at a time. Here you're going back to January 1st of 2014 through January 1st of 2023. I'm on a condensed horizontal or timeline, and that's so that you get all 10 years up through 2023 of your median. So these are the 10 years that I use for the median. And then you want 1 year to show the annual pattern, and then you want to see where the actual data is. And then starting on January 1st, 2023, I expand it so you can see what the trends are on an exploded scale. And you can see inventory normally comes crashing down at this time of the year. And you're going to crash down. It's just a matter of whether you're crashing down faster or slower than normal. But there's no doubt that inventory is going to be decreasing over the next several weeks. Here is that same information. I pulled the gray line, the median on the previous line, and made it 100% of itself, and then looked at how the purple line was changing. So you can see that we've had a shortage of inventory somewhere around 80% for 2024. And right now it's basically probably closer to 90% because you improved dramatically here. You went from basically, say, 75%, maybe even 75% up to about 90%, and then back down to 80%, back up to 90%. But the trend has been upward. So we're getting a little bit more inventory in as the year has gone on. And the same thing happened in the second half of 2023. You got more inventory. First half of 2023, you were generally getting less inventory. Basically, starting third quarter of 2023 onward, there's been a gradual increase in inventory compared to normal. So we're getting back into more normal levels of inventory. Here's the number of offers accepted. And again, just like inventory, you're going to expect this number to plummet down for the rest of the year. The question, does it plummet down a little stronger than the gray line median, or does it go down less than that, or does it go down more than? But there's no question we're in a period of time where we're going to see less and less number of offers going forward. Here is that same information with the gray line pulled out. So if you're having a normal year, you're way up here. Here, as far as offers, you've been basically flat. But if you look at it, I would almost say starting in fourth quarter, we had this rapid increase, and it may decrease and go away. But even if you say it's going to, after a flat level of inventory in 2023, starting in second quarter to now, there's definitely an increase. We've gone from 70% to 80%. So the market is coming back. It's still a shortage by a long way, and we don't know if this is going to go back down. But I would say the long-term trend is an upward direction, so I would expect it to continue in that long-term trend. I tend to be a believer that the market continues in the direction it's currently going, barring some outside force that causes it to change. Here's days unsold inventory. You can see the pattern is normally down, so the marketing time normally is decreasing at this time. And this isn't necessarily true marketing time. This is the ratio between the supply and demand. So it's the balance of the marketplace. So it's getting more and more competitive. And it typically does, as you can see by the gray line. And in this particular instance, it's been basically following the gray line fairly well. It's been a little bit slower than the gray line until fourth quarter. And fourth quarter, it's been following the pattern exactly normal. I'd expect it to continue to go down until the end of the year, and then it may reverse. Here is pulling out that line. You can see you were slower than normal, and then you got faster than normal, basically, as I said, for the fourth quarter. And the trend here is definitely downward. And again, that would tend to indicate a speeding up of the marketplace. Here is the actual marketing time. And I measure this by looking at what 3/4 of the sellers take to sell their property. Straightforward number. You can see you're exactly on normal. You're following the normal trend for the last couple weeks. So marketing time has been basically right where you'd expect it to be, and it's been following the regular trend. It was a little bit longer than you'd expect earlier in the year, but since October 1st, it's been basically exactly right on the trend. Now on the next slide, we pull out that gray line and look at it, and you can see that you had this rapid improvement at the start of the fourth quarter, and then you've actually had a slowdown for the last several weeks. So what this slide is telling us is this has been slowing down compared to normal. So that's saying that you started below the black gray line, which I would agree with. You caught up to the gray line, and now you might actually be slightly above the gray line. Very hard to tell on this graph, which is one of the reasons why I also put out the data here. This is where I take that moving curved gray line on the previous slide, pull it out straight, and then plot the data as a percentage of that normal marketplace. And you can see that we were just last week, we were about 96%, and now we might be about 101%. So that indicates the marketing time's increasing a little bit faster than it normally does. I would call it normal. I'm just pointing out the little nuances. Now what we're doing is we're realizing the vast majority of the sellers don't do any price adjustments at all. So we're only looking at the extremes. Not a good thing to do statistically, but we're looking at the 10% of the marketplace that's taking the largest price reduction and what are they doing. And right now they're asking 87% of their original asking price, so they've reduced their asking price by 13%. And that is more of a price reduction than they typically do. And it's sort of interesting is you got this fall down in this last week, which might normally be alarming, but you look at the historical data and it's right there in the typical price. And what's so special about this week? It's the weekend going into Veterans Day. I don't know if that is what it's tied to or not, but every holiday does negatively impact real estate. I actually think it's probably we're past Halloween. People are looking forward to the end of the year. They're realizing the market's slowing down, and if they need to sell this year, they come along and they do a price reduction. Here's pulling out the gray line straight, and you can see price reductions are been bigger than normal, probably somewhere around 15% above the normal level. It bounces a lot from week to week, and that's using a 5-week data. It would bounce a lot more if I used 1 week's worth of data, and I used 5 weeks to try to indicators of market changes versus just statistical bounces. Here's looking at the same information, but now we're looking at the average. So instead of looking at just the 10%, we're looking at everybody, including the 87% or so of the sellers that do no price reduction. And you can see that price reductions appear to be exactly normal. We were definitely taking larger than normal price reductions for the vast majority this year. We crossed over right at the beginning of fourth quarter, and now we're back on the line. And now we're stretching out that line, and you can see that here's the improvement we saw at the beginning fourth quarter. You were above, and now you're right at normal. And you've decreased coming into this week. If you were the same from week to week at 100%, you'd be horizontal right on that gray line. Here's the frequency of price reductions. So how common is price reductions? And right now, something like 17.5% of the sellers are doing price reductions. That's less than normal. So you have fewer than normal number of sellers doing price reductions with the normal price reduction, which means the sellers that are doing price reductions are doing larger price reductions than they typically do. Here's doing the same thing where I pull out the gray line, the typical line, and make that 100%. And you can see that the price reductions as far as frequencies, we're only about 85% of the normal number of sellers are doing price reductions. So 15% fewer sellers are doing price reductions. That's 15% of the 17.5% that normally are doing price reductions. So it isn't a huge change, even though it's a significant percentage. Now we're flipping over and looking at buyers. And I think this is actually sort of telling. And what this is saying is instead of decreasing amount of overbidding, the buyers are continuing to overbid about the same amount. That's saying that buyers right now, and since it takes about 5 weeks to get sold data, this is really what's going on 5 weeks ago. But all this data is compared, it has a 5-week lag time built into it. So it's saying that buyers are more optimistic, in my opinion, about the market's future because they're willing to overbid to get into a property right now than they typically are based on this time of the year. In my opinion, that suggests that 2025 will be a robust year. Here you can see normal. So going into third quarter, we had a significant slowdown. So the buyers were more pessimistic, and there was a noticeable slowdown this summer. And then basically from the first month of the third quarter, the market started to improve and continue to improve. And there's no indication of when that's going to let up, but that's indicating that buyers are overbidding more than they typically do for this time of the year. And you can actually go back and historically look at that. 2023 was, the bottom of the marketplace, and you can see the amount of overbidding, and it kept improving. And as the market did, there was the correction for the end of the year where things get weird. It improved. Then there was the unusual summer slowdown, and now they're improving again. Whether this will go down or not next year is, next week or not is hard to tell. It did last year, but I think this is going to continue up and stay flat, if anything. So I think that's saying that 2025 is going to start off to be a strong year. Here's the frequency of overbidding. Buyers are more frequently overbidding by quite a bit. Normal frequency of overbidding is down here around 62%. It's up here now around 68%. So that 6% higher overbidding represents 10% more than normal. So that becomes significant. And here you are, 10% more than normal overbidding. Normally you'd be down here at 100%. You're almost 11% higher amount of overbidding. So my math was pretty close from the previous graph. This gives you an idea what's going on with pricing. And normally you can see that we go up about the rate of this blue straight line through here. Every year you have a dip down at the end of the year, and somewhere you have a mountain in second quarter. We had this unusual decrease this year in magnitude and got below the blue line. There isn't many times when we've gotten below the blue line that wasn't at the end of the year. Now you're having buyers overbidding aggressively, in part because they might think that, they may be sensing based on the long-term prognosis of Silicon Valley real estate is the market should be turning around and going up again. Here's a summary of the information that we've presented. You start over here on the left side of the graph or your geographical areas, and you can read across and get market conditions, or you can start on the right side with your monthly payment or your total purchase price that you're looking at. And instead of following just the median numbers as most people do, I follow the cheapest 10 percentile and the most expensive 90 percentile in each marketplace, and that sandwiches it so you have some idea what the range of prices are to be expected in each micro market. And as you can see, the conditions vary fairly significantly depending on which micro market area you're looking at, which is why I think it's important to look at micro market data versus the global county or Silicon Valley wide data. Now we're moving on to distributions. These are going to be three distributions. The first one's on days on market. What I basically do is I start off a year ago and I jump approximately a month at a time. And I do everything on a weekly basis. So I jump either 4 or 5 weeks, trying to keep the day of the month roughly the same. As you can see, that we stay pretty close to the 8th of the month that we start off at. I use a fiscal year for my statistics. I start on March 1st and I go forward 7 weeks at a time for 52 times. And then on the last one, which I think is February 21st, and instead of jumping forward 7 days to the 28th of February, I jump forward 8 days to March 1st again. So and the reason I picked March 1st is there's already the discontinuity. Every 4 year we have a leap year. So now that discontinuity of leap year is tied in with the discontinuity that a typical year has one extra day than it does a week. And that way I compare the same day of the year to the same day of the previous 10 years. So the blue line is where we were a year ago. The purple line is where we are now. You can see the market is significantly cooler because you're more vertical up closer to the blue line. So it's taking the typical seller longer to sell. Now, if you really look at the typical seller back here at 50 percentile, it's the same. You come out here to the 75th percentile and it's bigger. So half the sellers are taking the same amount of time as they typically do. And that's the half of the marketplace that's willing to look at offers as soon as the seller is willing to look at offers. So it's only the second part of this graph that matters, which is why I look at 75th percentile for my days of market indicator instead of the median. The median's an artificially low number that's going to be way too stable. And in fact, I'm seriously considering moving this out to about 80 percentile. But we're starting off on this blue dash dotted line. And then you move forward and you can see at this time of the year, you're slowing down. There was the lowest. Then you turn around and accelerate. There's the peak of the marketplace. And now you slow down. And basically from that week on, which is August the 9th on to present day, there really isn't much change. The market bounces a little bit from week to week, but it really doesn't change much. And it's continuing in that realm of normal. Now, basically from those weeks there, there's a slowdown, there's a slowdown. So you could argue the last 2 weeks, we're starting to migrate up this graph. And in 5 weeks from now, you expect to be here, and 10 weeks from now, you expect to be up here. So we're at the time of the year where these lines are going to be starting to move up towards the blue line, blue dotted line pretty significantly, pretty rapidly. So you basically, as a seller, you'd expect longer marketing times. Doing the same thing with price reductions. We're going to start off on the blue line here, the blue dotted dashed line. There's the bottom of the marketplace 10 months ago. There's here coming up. There's the peak of the marketplace 7 months ago. Then you rapidly slow down for the summer, and now you're already in the summer doldrums, basically the middle of July. I think it was July 12th, if I read my number correctly. And this is sellers' price reductions, and they're really not changing much. You can see there's bounce from week to week, but there's really not much of a change. That was a huge and cool down, another huge cool down. So again, the last 2 weeks, there's been a cool down. So that would be, again, a strong indication that we're at the time of the year where the market's going to start cooling down. 5 weeks from now, you'd expect to be down here somewhere, and 10 weeks from now, down even here. So what do you expect as someone in the marketplace? More and more sellers taking price reductions. Now we're looking at overbidding. Now keep in mind, this is still lagging data because you need that close of sold price. And here the marketplace is right on top of where it was a year ago. So market conditions 5 weeks ago, it was what this is basically telling you, were identical to a year ago. But stepping through, starting a year ago, there's the bottom of the marketplace on January the 10th. And now you're improving. There's probably the peak of the market on May the 10th. And starting this week, which is August the 9th, you're basically at the summer plateau, and you're really not moving much at all. I mean, these data points are basically right on top of one another. It's almost hard to see the boldingness. There's sort of one of the lowest. Now you're moving up a little bit, but it's really not any change. Those two are right on top of one another. And even this week, there isn't the slowdown. Now, 5 weeks from now, we may be noticing the slowdown that we noticed in marketing time and overbidding, or not overbidding, but marketing time and price reductions. But we're not seeing it yet in overbidding because of the duration of escrows and the delay that causes in getting the information. Now what we're going to do is look at each component, and we start off with inventory. We start off in January 1st of 2014, coming all the way through January 1st, 2023 on a condensed scale. And then January 1st of 2023 through current day, we have the expanded scale so you can see the patterns. Basically, the blue line is Santa Clara County, the gray line is Alameda County, and the orange is San Mateo County. The big takeaways are San Mateo County has about normal level of inventory. Santa Clara is lacking in inventory and lacking in inventory the most. Alameda County is lacking inventory, but closer to its normal levels versus Santa Clara. Alameda clearly has significantly more inventory right now than Santa Clara, and historically they're roughly the same levels, especially if you exclude 2017. Here's looking at the number of offers. So even though Santa Clara had less inventory, it's got more offers accepted than Alameda County does. That means that if you're selling more with less inventory, it means that Santa Clara County is going to have a faster marketplace, a quicker days unsold inventory, and Alameda County will have a slower one. San Mateo County has less offers than they typically do with roughly the same inventory, and therefore you'd expect a slower marketplace than typical. Here you have Santa Clara, as I predicted, the fastest marketing time or days unsold inventory at 29 days. San Mateo County is at 40. And the reversal here is that San Mateo County is normally, if you come back in time, faster than Santa Clara. Basically, since the pandemic, it has been slower. And Alameda County is the slowest, as I thought it would be. Here's your actual marketing time, and the order is going to be the same. Alameda County is the longest marketing time. Santa Clara County has the shortest marketing time. Marketing time is climbing. Marketing time is defined as how long does it take 3 out of 4 sellers to sell their properties, 75% of the sellers to sell. Here's your price reductions. You can see that price reductions are all going down, which means greater price reductions, all right around 1%, somewhere around 0.9% for San Mateo County, probably about 1.1% for Santa Clara, and probably somewhere about 1.5% 3% for Alameda County. So close together. This is the average price reductions that sellers take to get the offer. This is the frequency, very close together, varying from basically for both San Mateo and Santa Clara County at 17% to Alameda County at something like 18.5%. So very close together. Magnitude of overbidding. Now, again, this is going to be the lagging indicator. You got to wait for those escrows to close. Here, Alameda County, even though it had the most price reductions and the most longest days unsold inventory and the longest marketing time, it has the most overbidding. How do I possibly explain that? I think what's happening, and it would make sense, the buyers tend to not go in and make an offer below ask price. It's just a phenomenon in Silicon Valley where they would rather wait for the seller to reduce their ask price. So the seller reduces their ask price and has been frustrated that he hasn't been getting the offers. He lowers it enough that now all of a sudden it's attractive for the marketplace. Multiple buyers come in and they overbid. So even though the seller had to be on the market, reduce their price, their offer when it comes in is now above their revised asking price, because this is not compared to the original list price, but the list price at the time the offer is, because that's the amount of the buyers are overbidding the seller's ask price. Santa Clara County comes in second at 6% overbid, and then San Mateo County is the least amount of overbidding at 5%. And this is average. It includes the buyers that do go in below asking price as well as those go way above. The median overbid, where the midpoint of 50%, is going to be lower than these numbers, and it's probably somewhere around 3 or 4%. I don't have that number. It is later in the presentation, though, if you're interested in it. Here's the frequency of overbidding. Alameda County is the most frequent overbidding at 69%, followed by Santa Clara at 65.8%. And then San Mateo has the least overbidding at 64. So basically, right close to 2/3 of the sellers are getting more than their asking price. Here's the long-term appreciation, including the original investment. So the appreciation for Santa Clara County is about 104%. Alameda County, it's about 70%. And San Mateo County, it's about 67% appreciation. And when you realize that you likely leveraged out your purchase with getting a loan and only a small percent down, probably somewhere around 20% for a lot of people, the rate of return on your investment is huge. Here is just the median price for the three counties on log paper. I've added in the horizontal lines, and that allows you to come back and see in Alameda County, you're right at the pricing you were at for 2023. So even though we went up this year and came back down, we're back to the same level of pricing as we were in 2023. Same for San Mateo County. You're right at the level you were in 2023 after you did a dip at the end of the year and overshot during second quarter. And now in third and fourth quarter, you're back down to the levels you were in 2023. Santa Clara County is a slightly different story where the prices are up fairly significantly from 2023. So in Santa Clara County, you've actually appreciated it and made money now had you purchased in 2023, where the other two counties, you're basically breaking even and we're going to lose money with your closing costs. Here's your sold price again on regular paper for those that prefer and no need the same information. Here's the estimated payments. I just assume an 80% loan. I use the federal national interest rate, and then I add in an estimation for property tax and insurance. And since the Federal Reserve reduced interest rates 0.25% this past week, everybody would probably assume housing interest rates were down. They have not gone down. In fact, they went up this week from last week, according to the Federal Reserve Bank. Now we're looking at micro market areas, and this is where I think is the benefit of my data and the importance is now you have a good understanding of what the market's sort of doing on a global level, but what's it doing in the specific area within Silicon Valley that you're interested in purchasing. You can see that you have a wide range. You don't have any blue showing up on this data. In fact, the only area that I'm seeing is Los Altos and Palo Alto with absolutely normal inventory at 101%. The area that's got the most shortage is Foster City, but that's so small, I'll ignore that. So let's jump up here to the Campbell area. It only has 57% of the inventory you need. So if you're looking in Santa Clara, Willow Glen, Cambrian, or Campbell, which is a great pocket, sort of in the center of Silicon Valley, more moderately affordable area, you only have less than 60% of the inventory that you normally do for this time of the year. So a huge shortage of inventory. Now looking at offers, here you can see there's a huge lack of offers, and that's why everything's blue. You got one area that's got a little bit of pink to it, and that's Los Altos and Palo Alto, where they're selling 20% more homes than they typically do. I do not have Alameda County micro market data for the first three slides, so I show county-wide data for each one of their micro market areas, and that's why the data is the same. Here's looking at the days unsold inventory, so the supply demand balance. You can see you range from anywhere from 66% of normal, so slower than normal for North San Mateo County, which is Pacific Daly City, South San Francisco, and San Bruno, all the way down to the opposite extreme, being Saratoga Los Gatos and also Campbell Los Gatos, roughly 70% of the days unsold inventory, the turnover rate. So it's turning over 30% faster than it normally does in those two micro market areas. Now we're going away from comparing it to normal to just what is the time frame. So the longest time frame is the expensive areas in San Mateo County at 92 days. The shortest area that I'm seeing right now is Foster City at 12, but that's such a small area, I don't want to rely on that. So the smallest area, the fastest turnover area I'm seeing is Fremont at 17, almost 18 days. And then also at 18 days is the Campbell, Cambrian, Santa Clara, and Willow Glen area at 18 days of days unsold inventory. So they would sell out their entire inventory in 18 days if there were no new listings coming over on the marketplace. Here's the time it takes 75% of the sellers to sell. You can see the fastest again in Foster City, which I've been ignoring because of size. The fastest is the Milpitas, Berryessa, Blossom Valley, and Santa Teresa in 18 days in Cupertino and Sunnyvale. Those are the fastest areas. The slowest areas that I'm seeing right off the bat is San Mateo County Coast at 53 days, and very similar 52 days for South County and Santa Clara County. There's a big difference between whether it's taking 52 days, approaching 2 months, versus selling everything in just over 2.5 weeks at 18 days. Here's your ask price adjustments. You can see the numbers are fairly small. The least amount of price reduction is actually sellers raising their price by 1/10%. This is average. Again, Foster City is a pretty small area, so I like to ignore that. So I would say maybe 0.4% here in the Milpitas, Berryessa, Santa Teresa, Blossom Valley area. And then the area that has the most is the San Mateo County Coast at 2.1%. And Los Altos there's Saratoga Los Gatos at 2.1%. So we have a two-way tie for the most price reductions or the largest price reductions. Here's the frequency as how common. We go anywhere from only 1 in 4 sellers are doing the price reductions, which is a lot for basically the San Mateo County Coast and the South County area of Santa Clara County. The least is Foster City at only 7%. We're going to ignore that. So let's go down to Hayward, where only 9% of the sellers do a price reduction. So that means 91% of the sellers are not making any price adjustments in Hayward at all. Now let's look at magnitude of overbidding. You have the least in Atherton, where you're coming in and actually reducing your price by 1.6%, so just over 1.5%. The area that's got the most overbidding magnitude is Berkeley and the city island of Alameda at 22%. So if you're asking $1 million and you have a 22% overbid, that's $1,220,000. That's huge. But if you ignore that, then you come down and you have 11% in Cupertino, Sunnyvale, and that looks like second place. Huge difference between top place being Berkeley and Alameda to second place being Cupertino. The bulk of the areas are probably somewhere around 5%, 6%. Here's the frequency of overbidding, least frequent in the expensive areas in San Mateo County, with only 29% of the sellers getting overbid. The most common in Foster City, again, probably Cupertino at 78% of the sellers are getting more than their asking price. Ooh, down here at Berkeley and Alameda, we got 85% of the sellers are getting more than their asking price. So Berkeley and Alameda is a hot marketplace, significantly higher than the other areas for amount of overbidding, both frequency and magnitude. Here's long-term appreciation. The bluer the color here is simply the areas that have had the least amount of appreciation. And you can see there's areas at 35% appreciation, And then on the areas that have the highest appreciation is the expensive areas at 119%. But then after that, you come down to Union City at 97%, Union City and Newark at 97%. Santa Clara County overall had 104% appreciation earlier, and none of these numbers are anywhere close to 104% appreciation. What that says is you're having a shift in market mix. You have more of the expensive areas, Saratoga, Los Gatos, Cupertino, and even Campbell. You have a larger number of those homes selling, which brings up your county-wide appreciation number more than any one of your micro market areas. And again, by looking at the micro market areas, you get to see this information. If you only looked at county data, you would think were getting 104% appreciation. But then when you look at each individual area, no one's even at 100%. And you're sort of seeing the data here. It says it's 103%, so maybe it's 103 instead of 104. So countywide, you're 103%, where the biggest individual micro market area that I'm seeing is 94, 93%. And you got some, oh, there's a 95, but then you also have some areas down at 78%. So it does make a difference. And then in San Mateo County, it's similarly, but we're 67% appreciation for the county. But if you ignore Atherton, again, a relatively small area, none of these areas are anywhere close to 60%. And most of them are, 53, 35, 46. I would say if you looked at the average appreciation in the counties, you would be somewhere around 50%. So again, you're having the shift in the mix of what's selling within the county. And that's why it's important to have more data than you really need, because without the extra data, you're not going to see these things. Here's your sold price, and instead of following the median, which is the middle number only, I add in the 10 percentile and the 90 percentile. So in any given micro market area, you expect a range. Color here is assigned by just where the price is. So the most expensive area is Atherton. The most affordable area is Oakland. Here is a summary. You can start over on the left-hand side in the micro market area of your choice, move across and see your market conditions, or you can start on the right-hand side with the monthly payments or the purchase price and come across and see market conditions. The yellow highlights are your strongest market indicators. The pale is a market indicator, but to a lesser degree. The orange ones are sort of the same. Orange is a lagging indicator because I need the sold price, but the magnitude of overbidding is more significant than the frequency. And the reason is a buyer is going to go from a 10% overbid to a 9% overbid to a 7% overbid, reduces overbid. That happens more rapidly and more reflective of the marketplace than he's going from overbidding to underbidding. So that's why the magnitude is the dark orange and the frequency is the lighter orange. Here's the actual raw numbers, a few key takeaways. Number of new listings for this week are way down, average of 7%, but it varies from 11% almost in Alameda County to 4.5% in Santa Clara County. The total inventory is basically down as well, down 3%, although it is up in San Mateo County by almost a full percentage points. Offers accepted is down across the board around 5%. Days of unsold inventory is both directions. Santa Clara County, a big county, is down. San Mateo and Alameda County are both up. You can see your raw data for Santa Clara, San Mateo, Alameda, or Silicon Valley as a whole, and look at whatever metric you want and get the actual raw number instead of trends. This slide is starting to become less and less important. You can see last year we had the record low number of offers accepted. This year we're at 2,000, so we're basically the third slowest year. There's 3 years that are slower than us, 2023, 2022, and 2007 are the 3 years that were slower. Only 2 of them are in the past 10 years. So we've been talking about Silicon Valley real estate market analytics for November the 9th. And then we will be talking very shortly about the Greater Bay Area, 13 counties. This is the YouTube archive of all the past presentations. Less typing if you type in what I call the green root URL. That becomes key because by adding 2024 to it, you get to the Saturday morning 9 a.m. presentations. You're more than welcome to join. Just type in the tiny URL, that /, S as in silicon, V as in valley, R as in real, E as in estate, M as in market, and then the year 2024. Passcode is here if it asks for it. The handout, 67-page PDF of the major slides that we went over is available. You type in the green root URL, add in H, the year, 2024, 11 for the month, 09 for the day, and you can do the same thing for any past presentation. Just leave out the letter H and you get to the video. If you put in the H, you get the handout. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers and sellers here. My email address and phone number, voicemail, personal phone call, Zoom meetings, text, whatever works for you. I would appreciate it if you'd like each video and subscribe once if you haven't already. And with that, we'll move on to Greater Bay Area. First region we cover is Silicon Valley that we've talked about at length already. Then we have the cities, San Francisco and Marin, then North Bay, Sonoma, Napa, Solano, and Contra Costa County, Central Valley, San Joaquin and Sacramento counties, and the Central Coast being Santa Cruz and Monterey. Here is your inventory. You can see all the regions are now down in inventory except for Central Valley. Central Valley looked like it went down last week, but it came back up this week. So it's at the plateau. I would expect it to be going down very shortly, very probably even next week. Central Coast looks fairly flat, but I think it's down from its peak. The offers accepted is going all over the place. You got a strong upward trend in the North County. You're down in Silicon Valley. You're down in the Central Valley. You're up moderately in the cities, and you're slightly down in the Central Coast. Again, I would expect the number of offers to start turning down in all the regions going forward. But this shows that just like within each county, you need to look at the micro market areas. Within Northern California, you have to look at each one of the regions. Within each region, you have to look at each county and then each micro market area. Here's your days unsold inventory. Silicon Valley is the fastest marketplace. This is the turnover ratio, followed by the cities, North Bay, Central Valley, and the slowest being the Central Coast at 82 days. So basically, Silicon Valley is half the speed, twice as fast as Santa Clara, half the speed, depending on how you want to look at it. Here's your marketing time. So how long is it taking 3/4 of the sellers to sell? Same order, probably. Santa Clara County is at 30 days. Then you go all the way up to Santa Cruz, Monterey, the Central Coast at 58 days and in between. Here's your price reductions. The Central Coast is having the most price reductions that are at about 2.6%, followed by North Bay at 2%, Central Valley at 1.6%, cities at 1.3%, and Silicon Valley at 1.15%. Here's the frequency of those price reductions, most frequently in Central Valley. So I think that's actually a slightly different order, but the most frequent are in the Central Valley. So the Central Valley is doing more but smaller price reductions than the Central Coast, North Bay, the cities, and Silicon Valley having the least amount of price reductions. In Silicon Valley, it's less than 18% of the sellers are doing a price reduction. Here's the magnitude of overbidding. So this is what our buyers are doing. And you can see Central Coast has turned around and it's below 100%. Central Valley is right at 100%, just a tad under. North Bay is about 0.5% over. So the only two areas that have significant over or underbidding are the cities at about 7% and Silicon Valley at about 6.5% overbidding. Here's the frequency of that overbidding. Silicon Valley is by far the most at 68%, just over 2/3. Cities at 60%, dropping all the way down to 42% for the North Bay, 37% for Central Valley, and just 30% of the sellers get overbidded in Santa Cruz and Monterey. Here's the total appreciation. Noteworthy. Look at Central Coast. It shot up and has the most overbidding, followed by the Central Valley. So even though Silicon Valley is doing well, it doesn't have the most by any stretch of the imagination. And Silicon Valley has less than Santa Clara because Santa Clara had 104%. So Silicon Valley is getting weighed down by Alameda and San Mateo County. But the areas with the most, again, are the Central Coast, followed by the Central Valley, then Silicon Valley, then dropping down significantly to the North Bay at only 68%. And then finally, in last place is the cities. And the cities has done significantly poorly since the pandemic. Here are the median sold price. Cities has now come back up and is above Silicon Valley. And this is both counties. Silicon Valley is all three counties. It's Alameda County that pulls down Silicon Valley. Then the Central Coast is in between in the middle. North Bay is the second most affordable, and the most affordable is the Central Valley at about 550,000. Then your monthly payments, they're going to be in the same order. You can start seeing the large increase. The increase this week is in part because the interest rates went up. So even though the Feds dropped their interest rate 0.25%, the average 30-year fixed interest rate, according to the Federal Reserve Bank out of St. Louis, for the country actually increased last week. Here's the raw numbers, the different metrics going across the top, each one of the 13 counties down the side. I also have Silicon Valley and the Bay Area. The Bay Area, I feel, is a real garbage numbers because no matter what number you pick, the variation is too much. 25.6% for the frequency of overbidding doesn't reflect the 38% that you have in Napa and Solano, nor does it reflect the 12% overbidding you have in San Francisco. And that's what happens when you put in unlike properties. My micro market areas I selected, I try to group them by very similar properties. So hopefully the market conditions are the same so you don't get garbage in, garbage out. So here is sort of Silicon Valley real estate marketplace. I'm not seeing any unmuted mics, so I'll go in and explain it. These are the different chapters. So they're in the order that they appear in this video, and you can jump to any one of these chapters you want and see what they are. And here's a brief discussion. So we started off with the key market indicator summary of the past 14 weeks for 5 indicators, and then the overbid just because it's such popular demand. Then we went into the 3 key components all the way back to 2014, and then we dove into each one of the metrics. That's the first 3 chapters. Then we have the 3 distributions, the marketing time, the seller's expectations or their ask price reductions, and the market competitiveness as measured by the amount of overbidding. Then you move in and we look at the 3 counties that make up Silicon Valley. We look at Santa Clara County, San Mateo County, and Alameda County individually, compare and contrast. Then we get into the key micro market area indexes. Then we have a summary so you can look across and see all the market conditions. Before we leave Silicon Valley, we have the raw numbers where you can look at either Santa Clara County, San Mateo County, Alameda County, or Silicon Valley as a whole, and the different metrics down the left-hand side. This is showing the low volume. We are starting to improve. There are 3 years now out of the last 25 that have lower volume than 2024. For a while there, we were having the worst out of the past 25 years, so we've improved, and that's why it's becoming less important. Then we've talked about how to participate live and how to migrate to whether you want the handouts, the YouTube channel. Then we move on to the Greater Bay Area and the 5 regions, and then the actual graphs of each one of the characteristics of those 5 regions, and then the raw data. So that allows you to jump to the section you're more interested in and not waste your time on parts that don't interest you. With that, I'm not seeing any unmuted mics, so I don't have any questions. Look forward to people joining me Saturday morning at 9 and ask your questions during the live presentation. Take care. Bye for now.